Your money, your stories, your freedom. The Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. We're taking your calls, 855-4SCHIFF, 855-4SCHIFF, as we continue to live in the investment twilight zone with treasuries rising again today as a flight to quality because of the worries over treasuries. You know, this really shows you the absurdity of the global dollar standard, and this is the last gasp of the dollar's role as the reserve currency when the dollar is a safe haven from the dollar, when treasuries are a safe haven from treasuries. And Ben Bernanke did exactly what I said he was going to do years ago. In fact, when Ben Bernanke first announced QE2, I said that it would not work, that it would artificially pump up spending, that it would cause commodity prices and gold to rise, the dollar to fall, and that when QE2 came to an end, the economy would go back into recession and the Fed would come back in with more QE. Well, they are not calling it quantitative easing, but they're doing it. And Ben Bernanke, in an unprecedented move yesterday, came out and told the world that the Fed was going to leave interest rates at zero for 2 more years at a minimum. Of course, 2 years from now, how can they raise interest rates from zero? Because if the U.S. economy cannot withstand rate increases now, how is it going to withstand them 2 years from now when it has that much more debt? See, the problem is the longer the Fed waits to raise interest rates, the less likely they are to raise them because the more pain it will inflict on the economy. You know, I was on Fox Business last night. And by the way, I'll be on again tonight. I'm on Fox Business twice today. I'm on at 1 o'clock and then again at 10 o'clock. These are Eastern times. But I was arguing with this guy. And his point was that interest rates are going to stay low forever. They're never going to go up. And it's absurd. It's patently absurd. It's, you know, the people who thought real estate prices would always go up are now making the exact same mistake by thinking interest rates will never go up. Of course they're going to go up. And the point is, how does the economy withstand higher rates when everybody is in debt? But in the meantime, we are inflicting massive pain on all the savers, on all the creditors, which is why they're sending money out of the country. Now, after Ben Bernanke made his statement, the stock market initially sold off a bit, then rallied over 400 points. The Swiss franc skyrocketed. I have never seen the Swiss franc up. At one point, it was up like 7 cents on the day. That was, over a 5% move in one day. That basically meant that even though the Dow was up 400 points, from the Swiss perspective, it actually went down. Last night, the Swiss government intervened against the Swiss franc by printing Swiss francs, and now the Swiss franc is back down to 136, but barely. Now, I talked just a couple days ago about the Swiss franc hitting parity with the euro. We almost hit it. In fact, we're pretty close now. We're at 136 and change on the franc and 141 and change on the euro. We're only about 4 cents away from euro-franc parity, which, as I said, I think is coming. But the one money, or the only money, the one thing that central banks can't print is gold. And gold, which had been up $50 earlier yesterday, ended up only about 10 or 15, is up another $40 today. It's not at a record high because the record high was set yesterday. But if we close here, it'll be a record close. Of course, we could make a record high later in the day. Silver is up about $1.20, which is basically just getting back to even off of yesterday's losses, which were about the same magnitude. The Japanese yen is almost at a record high today. It's very close. The only thing that's keeping it from making a new record is the fear of intervention, which is obviously there. But again, that simply lowers the safe havens down to gold. I think ultimately silver is going to be included in that safe haven mix. I'm waiting to see the silver breakout. I do believe that it is coming. Meanwhile, the dollar was getting shellacked earlier this morning until the U.S. stock market sold off. The Dow is now down 400 points. We've almost erased the entire gain from yesterday. And, of course, as soon as the stock market started to go down, that's when the dollar started to rally against the Aussie, against the Kiwi, against the euro, against the pound. Why? Well, investors want a safe haven, and they're buying the dollar. But why do they want a safe haven? Because the U.S. economy is collapsing, because the U.S. stock market is selling off. why on earth, if you're worried about the U.S. economy, if you're worried about the U.S. stock market, why would you seek refuge in the U.S. dollar? See, it makes no sense. The dollar can't be a safe haven from the dollar. And this is the unraveling of this concept. And obviously, some people are figuring it out. That's why gold is up $42, right? And as more people figure it out, gold will go up more and more until they finally stop selling off these currencies. And what I think will really show you the beginning of the end is when the stock market goes down and the Aussie dollar goes up, right? And the euro goes up. When people stop buying the dollar as a safe haven. And then I think the next thing will happen where treasuries will start to go down. That might be the last part of the bubble to burst, but it will burst. And then what are we going to do? You know what? The reason the Fed is keeping rates at zero for 2 years, and of course it's going to do it indefinitely, but the market will eventually stop them. If rates go up, the federal government is bankrupt. If rates go up, the states are bankrupt. Look what was happening to the banks. Bank of America was dropping like a stone, and Citigroup was dropping like a stone. These big banks will fail if the Fed raises rates to where they need to be. See, we've got this phony economy that can only exist if interest rates are kept at zero. The slightest move up will topple it. But that means the economy can't survive, because what damage are 0% interest rates doing? Who's going to save? Nobody. If you've got any savings, you're going to send it abroad. You're going to put it in gold and bury it in the ground. You're not going to put your money into job-creating activities. You're not going to fund capital investment because there's no money. And everybody, the show was on last night. People were talking about, hey, this is great. People can refinance their mortgages. It's great for the borrower. It's a lousy deal for the lender. And who are the lenders? The banks, the insurance companies. And of course, when all these refinances happen, for government for Fannie and Freddie loans, well, now they're making less money on the loans that are performing, but they still have all the losses on all the foreclosures. So ultimately, lower mortgage rates are going to impact the government by meaning more bailouts, because you're going to have less revenues on the people who are paying to offset all the people who are not paying. So it's bad for a big section of the economy when you have these ultra low interest rates. And of course, the more we load up our financial institutions with low-yielding debt, then the more they're going to lose when rates rise. And also, think about, what about insurance companies? They have to invest in bonds to get a return. If they can't get as high enough return, they got to raise their premiums, because they have to make enough investment income to cover their expenditures. And if interest rates are lower on the bonds that they own, then they need to charge higher premiums to their customers for their fire insurance, for their health insurance, for their automobile insurance. All this stuff is going to cost more because interest rates are at rock bottom. It's not just a win. But of course, the most important thing is these low rates are doing real structural damage to our economy. They are aggravating the misallocation of resources, land, labor, and capital. And all the Fed has done is guarantee that things are going to get worse for the next 2 years, not better. There will be no jobs. There will be no recovery, only inflation and debt. Anyway, don't go away. We'll be right back here at the Peter Schiff Show at schiffradio.com.
Peter Schiff Show.
It's clear to just about everybody that the global economic sands are shifting. Have you positioned your investments to help ride the tide?
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff here at the Peter Schiff Show, and watching the markets fluctuate. Dow down just under 400 near the lows of the day. Gold up $42 an ounce. Gold stocks flat, down slightly again. Gold stocks are not really following the price of gold. They're following the stock market. But the fundamentals for gold are improving, for gold stocks rather, are improving dramatically. And in fact, they're some of the only companies that you could really say for sure are seeing their fundamentals improve as we speak. Yet despite that, nobody is buying. So who knows? I have a feeling that there's a lot of margin calls out there. My bet is, because the bullion is bought by big-time investors all around the world, central banks are buying. Central banks don't buy gold stocks. They don't buy numismatics either. They buy bullion. And so I think what's going on is a lot of the players who were bought up. I mean, there are a lot of people. I mean, Henry Paulson, I don't know if he's doing any selling, but his strategy, he's long gold and he's long the banks. He's long the financials. Now, I can imagine there are other hedge funds out there that are long financials and long gold stocks, or long something in addition to gold stocks, and the market is imploding. And as a result, they're needing to raise cash, and so they're selling gold stocks to do that, especially since their gold stocks are not down. And sometimes when people are trying to get cash, they don't want to sell the stocks that are getting killed because they feel they just don't want to psychologically. So they sell their gold stocks, which are not getting killed, but that selling is preventing the prices from going up when the fundamentals would dictate it. But what happens is when all of that kind of forced selling is gone, then who's left to sell? Well, nobody. Well, now the buyers are coming in who understand the fundamentals. They had been buying from the people who were forced to sell, so they got a good deal. But all of a sudden, the people who were forced to sell have sold. You still have fundamental buyers. The price has to go way up because now you've got to convince somebody to sell their gold stock that doesn't have to. And if you don't have to sell, why would you sell at these prices? If you own gold stocks, and I own a lot of gold stocks, looking at gold at almost $1,750 an ounce, why would I want to sell one of my gold stocks? Why would I want to sell a gold stock that's for the same price it was trading at when gold was $500 an ounce lower or $1,000 an ounce lower? Why would I want to do that? There's no way on earth I would do that. Now, if I was forced to do it, if I was having a margin call because I was all levered up, then I'd have to do it. But fortunately, I didn't put myself in that position. I didn't put any of my clients in that position either. That's one of the reasons that we do not use leverage. We do not encourage people to use leverage because I don't want them to be in a position where they have to sell good companies at fire sale prices. But a lot of hedge funds are leveraged. Why are they all levered up? Because they make a fortune if these levered bets are profitable, right? If the levered bets don't work out, their clients take the loss. If the levered bet works out, they get 20% of the ups, which is huge. And, of course, thanks to a loophole in the tax code, they only have to pay long-term capital gains on that, despite the fact that it's every much ordinary income, just like anybody else's income. But anyway, that's digressing a little bit. Hey, gold's making a new high of the day, up $46. Let me take a few calls. My guest is not coming on till 11 o'clock. It's Charlie Gasparino of Fox Business now, or Fox. He used to be at CNBC. Now he's over on Fox. Actually, I ran into Charlie at the lobby of Fox the other day and invited him on the show, so here he is. I'll be on later today. But let me take a couple of quick phone calls. First up is Tim calling from Chicago. Tim, welcome to the show.
Hi, Peter. How you doing?
I'm doing okay. Still trying to get my voice back, but other than that, I'm okay.
Yeah, you do a lot of talking, so I imagine that's pretty rough on your voice. Quick comment for my question. Harry Markopolos, I think, would be a good guest on your show, the guy who was screaming about Bernie Madoff for years. I think you guys have a lot in common with no one would listen. He's got a documentary, so he may want to promote that.
Yeah, it's like I keep telling the SEC about the NIA, and they haven't done anything yet. So, yeah, it pisses you off when you know somebody's ripping people off, yet they continue to do it.
Right, yeah. It'd be interesting to hear you guys talk. But the other day, Bill Gross said that a depreciated dollar, while bad for our standard of living here, would revitalize our manufacturing base and make it more competitive.
No, it won't.
Kind of a perverse point?
It's not going to make it more competitive. Not if we keep on taxing and regulating the way we are. Because if a lower currency would revigorate our manufacturing, why hasn't it already done it? The U.S. dollar has been falling for 30 or 40 years, and we've been losing manufacturing jobs the entire time.